guys. Thanks, Zach. So we have Zach here, Zach Springer with RPM, and we have a nice opportunity to partner on a GP level fund, and RPM, and we've been discussing now for several years how to work together and how to have a partnership, and I'm also an LP in your previous fund, and have some experience working together. So now we have a nice opportunity to work on a new fund together. And Zach, thanks for being here, and would love to have you kind of go through the deck and the major points about this fund and what the opportunity is, and of course about why we want to partner with RPM and why RPM feels a good partnership with PREH as well.
Absolutely. Well, thanks for having me, and appreciate your trust in us on your earlier investments. So just to touch a little bit on the opportunity, we are currently raising a GP co-invest fund for our multifamily acquisitions around the country, mostly the Sun Belt, Mid-Atlantic, Midwest. The fund will be diversified into, call it 30 to 40 assets. Really, it just depends on the size of the assets that we're and the opportunity set that we're buying. We'll deploy the money over the next 18 months to 24 months. Ideally, it may be, there may be a couple months added to that, just depending on the opportunity set, and we may deploy all of it in the next 14 to 16 months if we think the money is best spent in that window of time.
What's going to be the type of assets that we're going to be going after, or that you're targeting, and which markets as well?
Yeah, good question. So, all Class A multifamily. Our target deal last year, we bought 21 deals, about $1.5 billion in assets, kind of across the Southeast and Texas. The buy box is, call it 2010 and newer assets at 20 to 50% below replacement cost, which we do feel like, and we'll touch on it later, we feel like we're in a unique window of time, given the recent spike in interest rates over the last year and a half or so, where there's just a lot of pain and distress in the market, especially in this newer product type. And so we're going to be buying assets that are, again, well below replacement cost, where we have a path to a stabilized high 5 to 6 yield on cost, and in locations in high growth markets where your cap rate and your exit cap, even pre run up, was in the mid to high 4s, and so you're creating a lot of margin there, and obviously buying well below what anyone could go build it for. So in essence, these trades that are occurring now are shutting down future supply, because it makes no sense for equity to go build in these areas if you can buy newer that far below replacement cost. And really, the cap rate difference between a newer 2010 a newer asset versus a 1970s 80s asset is there's very little delta at the moment. That may change in the future, but right now you're basically buying you're getting the similar yield at a newer product without the headache of all the capex costs below the line that eat away your cash flow. So from a location standpoint, we're targeting the highest growth markets in the low supply pockets of those high growth markets, effectively trying to target shoot to where we think is going to produce the highest natural rent growth over the next 3 to 4 years.
But one of the interesting things is also to me and our investors is the institutional partnerships, and kind of how this whole fund is stacked. And from my understanding, and I'd like to learn a little bit more about those institutional partners are going to be putting about 90% of the capital, or 95%, and then RPM somewhere 5%, and then PREH, we have an opportunity for around 2% of the total fund. But wanted to learn more about the institutional partners and your relationship with them, and how they're going to be a part of this fund that we're working on together.
Absolutely. So every deal we buy, we're buying with an institutional JV partner. And so our largest partners are the largest private equity firms in the world, certainly domestically. So last year we bought, 4 of the 21 deals we bought were with Carlyle Group, who have a $9.5 billion fund. And one of the best, you look at their track record, one of the best institutional investors in the world on the real estate side. And then KKR is also a large partner of ours, AXA Insurance, DRA, Goldman has been a partner. We have, and that's my role in the company, is I run and manage all of our equity and debt relationships. And so at the moment, we have docs with 25 different institutional JV partners, of which will be 90% of the capital in any deal that we buy. So currently, we're raising a $75 million fund, of which we've raised roughly 50 of the 75 million. So there's 25 million-ish left, give or take a few dollars at the moment. And, we look to close that out in the next 30 to 60 days max. And that capital, that 75 million, will represent the 5 to 10% piece of any deal that we buy with an institutional partner. And so, if we're going to buy a $100 million deal and we're going to finance it at 70% leverage, we got 30 million in equity, will be 1.5 to 3 million will come from this fund, and the other 95% will come from our institutional partner. And so what that does is it allows us to scale nationally, where we manage and where we have acquisition personnel and where we have relationships to go find opportunities. So we've got acquisition personnel all over the Sun Belt, Mid-Atlantic, Midwest, that are finding deals. What this fund will allow us to do, putting in 1.5 to 3 million per deal, will allow us to scale nationally over the next 18 months to buy 30 to 40 assets. And so if you invest in the fund, you're going to get a highly diversified multifamily investment across 30 to 40 assets, which translate into 3 to 4 billion of total capitalization. So your dollars go a long way, which is good for diversity.
And have you worked with these partners before? And kind of going into the RPM, like why RPM? These institutions obviously have the money themselves.
Institutions need a sponsor. So Carlyle, KKR, they don't have direct acquisitions arm. So they have multi-billion-dollar funds they're trying to deploy in all food groups of real estate. And so they have select sponsors that they pick and operators in the multifamily space, in the industrial space, and to go help them deploy that capital. I'd say what sets us apart and gives us an edge on the investment side is really our management company. We're the 3rd largest manager of apartments in the nation, at just over 220,000 units. Why that's important, and most of those are Class A assets, what we're targeting to buy. So that helps us for a couple of reasons. In real time, if our deal team is going to look at a deal, let's call it in Uptown Dallas, which we bought a deal last year in Uptown Dallas, 2014 deal that Greystar owned with GIC. And we managed 2 of the 5 rent comps. And we had a regional manager that had managed the property we were trying to buy. And so, where you really want to not fault on multifamily investing is in your year 1 assumptions and pro forma. And so having a management company that you can lean on for data, not just in certain submarkets, but in micro pockets where you're buying, and be able to get real-time data. So what does that mean? We can understand what the lease trade-outs look like in our comps around us. We can understand who's renting there and why they're leaving. What are the demographics? And so it kind of proves out our underwriting is just going to go deeper than most buyers because we know exactly what we're walking into. And we know exactly how far we can push the rents. If we're going to go spend $15,000 a unit on a unit upgrade, are we going to be able to push it $225 a month? Well, let's look at the demos. Let's look at the demos of the deals we manage nearby. Did we do a value add deal in the same pocket for us or another client where it did hit those premiums? And so I think there's just a lot of data we can uncover. So I'd say the management sets us apart. That's a big reason why institutional investors want us to partner with them. And that's why we have 25 partners and counting I mean, that number was 16 3 years ago. Now it's 25, and it's probably growing from there because of our management presence. And so I'd say that's a big edge. And then look, we're a highly relational firm, very well tenured. The multifamily space is not a big space. A lot of the owners and investors, over a 20-year period, you become very close friends with a lot of these folks. And so, I've been in it 20 years. My partners, that also, there's 4 of us that sit on investment committee. And then the person that runs our management company, we've all been in it 20 plus years. Our acquisition personnel. So Ron Bonneau runs our acquisitions. He's based in Atlanta. He ran the Southeast for a very large private equity institution he was there for 13 years. And then we have acquisition guys in Austin, in Houston, in Miami that runs Florida, in Atlanta that runs, Carolinas, Tennessee, Denver, Vegas. So we have them all over, and they're not, 25-year-old grad school students. They're 30 to 40-year-old, acquisition professionals who have been doing it for a long time. And we're just very highly connected. So I was on the brokerage side for 15 years at Newmark in Houston and helped run that office. And so if we want to win a deal, we're likely only getting beat by Blackstone because they can pay more and they're the Goliath in the industry, and props to them for raising that much money and executing the way they have. But if we want to win a deal, we're probably hard to beat. I think you could go interview the top brokers in the high growth markets that we're targeting and ask them to list out who are 3 to 5 buyers you would go to on an off market deal. And I think we'd be surprised if we weren't on that list. And that's why our deal flow is so great. We're very picky, but we see a lot and we have the bandwidth to underwrite a lot. So, and I think the importance, and not to be long winded, but the importance in winning the deal that you want to win is highly important, because what you'll find a lot of buyers do that need to get money out or, have pressure to buy deals is they will lose that first deal that they want and they'll go overpay for the bridesmaid. And we're not in the business of doing that. So, there's a very high important, stressed aspect to our business to win the deal we want to win. If you look at the overall multifamily market fundamentals right now, we have just gone through and continue to go through this year the highest wave of supply in the last 50 years. And so what that's creating is depressed rent rolls and depressed NOIs. At the same time, a lot of these developers and owners who bought in 21 and 22 are facing, debt and note payments that are well above what they perform in. So they're facing lower NOI because of all the concessions in the market from the high supply, and they're facing higher debt payments. And that math just doesn't work. And so that's what's creating the distress in the market right now. And so it's not like the GFC where, you have a wave of REO and foreclosures hitting the market because a lot of that was financed through CMBS and was crossed. And that all went to servicers and hit the market at once. So 2 deals go bad, 30 others may go bad because the first 2, it's a snowball effect. And so now it's way more discreet, and you really have to be in the deal flow to find the opportunities. A lot of the distress that's selling right now is not hitting the market, and it's not fully marketed. And so you have to be, in the mix and, in conversation with all the lenders, which we manage for, and with a lot of these owners, which we manage for. Myself and all our partners have been in the multifamily business for, 20 plus years. And so we can speak with expertise in that field. But, as someone who lived through the Great Recession and before, and saw what happened in the multifamily industry nationwide, and the opportunity set that all the distress from the financial crisis caused into all sectors of real estate, and the liquidity effectively going away in that industry, the basis at which you could buy multifamily in 10, 11, 12 was so cheap that those assets traded 3 and 4 times over between 2010 and 2022. And so the fortunes that were made in that 10-year window were off the charts. And interest rates certainly had a lot to do with that. I think the popularity of multifamily had a lot to do with that. If you look at, multifamily was not always an institutional, especially on the international scale, an institutional asset class. It was a very safe real estate bet for those that invested in it, but it was really kind of more of a mom and pop, small private equity investment class. And really post GFC, it really started becoming more institutionalized, where pension funds and institutions were becoming heavy investors. And so, fast forward, why multifamily? I'd say a main reason is because of, if you look at the capital flow into multifamily now versus where we see it going, I think we're, to use a baseball analogy, I think we're in the third inning of a 9-inning ball game. I mean, the amount of capital on the sidelines from institutions wanting to get into multi, and really the two darling classes have become multi and industrial. Office has kind of gone to the side, retail has kind of gone to the side, big box, storefront retail, unless it's specialized or boutique or grocery anchored. And really all the money is flowing into industrial and multi. So, and really what hasn't really hit yet on a scale that I think is going to hit big is the international capital coming into multifamily in America. As I mentioned, my sole job at RPM, or one of my sole jobs, is to talk to equity all day, every day, to partner with us on these deals. And a lot of that has become foreign capital sources, major foreign capital, pension funds, sovereign wealth funds, in the hundreds of billions AUM, that didn't even understand what multifamily was. This is Middle East, Far East, didn't understand what multifamily was 5 years ago. And now they want a domestic sponsor in the US to invest in. So I'd say, why multifamily in the US? Because capital is flowing into the US from domestic and internationally, and that's only going to become greater, in our opinion. And I think you could ask any institutional peer of ours, and I think they'd say the same thing. I'd say from a timing standpoint specifically, why now versus 2009 and 10 and 11 is there has been due to interest rates and the wave of supply, this is the first market we've seen in 15 years where there is significant distress in the market. And you can buy 20 to 50% below replacement cost. So if it cost me, I'll give you an example. We bought a deal in Houston last year. Carlyle was our partner. There was an institutional seller that bought this asset. It was a suburban 4-story garden asset in a great suburban location in Houston that they bought for $210,000 a unit in lease up, 50% occupied. They bought it in 21. We bought it from them at $168 a door last year. So the institution basically set $35,000 a unit on fire, and said, you know what, we're out. This is a small blip in our fund and our fund returns. One of the last deals in our fund, we need to sell. And that's where we are. We want to go win those type of deals. And so if we can go buy a brand new 4-story elevator service apartment property in a nice suburban location for $165 a door, and it costs $210 to $220 to build it, that's a safe bet. Your downside, and that opportunity has not been there for the last 15 years, and it's here now. And we think that window is 18 to 24 months until it's over. The good thing about partnering with so many institutional investors that we partner with, they're the same institutions that back developers. So in real time, we understand what they're looking at, what they're looking to build, what they're saying no to. And so we understand how hard it is to get a new development, multifamily development, penciled in any of these markets based on current interest rates, current rental rates, and current exit cap rates. The math just does not work to build. And so, unless it's some unique opportunity to develop, these equity partners are in the buy mode. They're not in the develop mode right now, which is just furthering, out the timeline to when a new wave of supply will hit, which we don't think is probably going to be, again, this is our opinion. I think a lot of folks would agree with us in our space, but probably not till 2028, 2029, maybe 30, and probably 29 and 30 when they actually get developed in a big way and deliver. And so, and our goal is to be out before then or by then. So, we don't run into that. But as it stands now, if you look at the supply pipeline for 26, 27, 28, it is, 20% of what it has been. And the population growth and the job growth is still there in these markets. So, I think if I had a crystal ball, which I don't, but I would say 26 is going to be a lower year for development. And it's going to be a year where you're going to start to see some stabilization in a lot of these oversupplied markets and start to see lease trade outs positive. And then 27, 28, 29 should rip. I mean, you're going to be fighting very, very little supply. And if you're in a high growth market in a low supply pocket with a good product, we think the rent growth is going to be very strong, which should lead to higher returns than what we're underwriting. But that's our thesis. We think the opportunity set to buy this opportunistic, distressed vintage of assets is going to take place over the next 18 months, give or take a couple months on either side. So we think all this money will likely be deployed by late next year, latest is our thought. Based on some of the assets that are already seeding the fund, which you asked earlier, which I will touch on, and the opportunity set we're seeing early on in this fund, we think they're going to be pretty quick turnarounds, even without cap rate compression. And so, because they're distressed and they're more operational plays, and you can get in and get out. And so the average hold time is going to be 3 to 5 years. I think more than not will be 3-year holds, maybe some 2, maybe some 4. I think it'll be fairly unique in this cycle for us to hold something 5 years. And one thing that's important that could be a question from your investors is we negotiate a buy-sell agreement with all of our partners for 2 to 3 years. And so if our partner who's a 95%, you think about control issues with a partner that's 95% of the equity, we have a right within 2 to 3 years with our partnerships to sell. And so we can go get a couple valuations and we can take it to the market, or they can buy us out, either one. And so we have an outlet to get out and when we want to get out, which I think is very important.
Just a lot of great information. Also, why are you interested or excited to work with us, with PREH? I know we have some common people, but you can also work with anyone. I mean, so we appreciate the opportunity, but just from your side, what do you see as some positives or interest for you all to work with us?
Yeah. I mean, look, this business, and it's similar to when we're buying assets, it's all about relationships. And so, the fact that PREH and PREH and I used to be partners means a lot. So I think automatically there, we know it's someone we could be aligned with. And that's who we want investing in our co-invest, in our GP, are people that we're aligned with, that understand the business, that understand the business plan, and that we can go back to. That if we perform, we can go back in our next fund or our next raise or next opportunity and come back.
Wonderful. It's always about the relationships there, right? So
yeah.
I appreciate that very much. So I know you have something in a couple minutes, Mike, if you have anything else or if you want to ask us anything, but I think this was a really awesome, great vibe and great call and a lot of wonderful information, and definitely appreciate your knowledge and sharing all of that as well. So we're excited to put it together, and was really happy and learned a lot. So thank you.
Absolutely. Well, thanks. We're excited. We'd love you guys to invest alongside us, and we'll do our best to be good stewards of your money.